Good evening, everybody. My name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using an income-focused strategy. There we go, in closed-end funds. It's not polished, as you can see. It's certainly not scripted, and it's definitely not herd thinking. We don't chase headlines. We navigate markets. And I'm not a financial advisor. I'm a strategist, and I go where the data leads, even when that means walking alone. So welcome back. So here's the quick review. The noise tapered this week, and underneath it, the same financial currents are still flowing. The herd is still chasing easy money and the reflections of last week's market. We're not. We're positioned in the current, moving forward, scanning ahead, and filling the dividend dump truck as we go. So, with 100% transparency, I am behind on updating the portfolios. I'm quite behind in several things. Not being lazy, there's just a lot going on. I've got personal finances to tighten up, home repairs lined up, business ledgers and models, and book developments, and extra full-time job workload with students and HOA duties. HOA duties focusing on financial restructuring, and it's just a heavy season for me. And I'm not stopping, just prioritizing. So portfolio updates are coming. I can show you what I did buy last week, but portfolio updates are coming. I just need to clear a few items off my docket. So let's get into this. The markets. Last week or late last week, markets shifted and the direction became clear. The Iran conflict de-escalation signals continue to improve. Broader geopolitical easing seems likely, and we have more positive U.S. economic momentum. The markets don't wait for signatures. They move on expectation. And they moved as soon as President Trump announced the updates. And what we're seeing now is a very different environment than a week ago. The energy reality. Yes, gas spiked with the Iran conflict, but supply chains held, stores stayed stocked, oil is already pulling back. That's not a broken system. That's just a fear spike. And underneath that, the US is strengthening its position as a global energy hub. We have increased domestic product. Man, these videos after I have just extremely late nights just are harder to make. Uh, and I'll apologize in advance. When I'm tired, man, it's like the gerbil powering the hamster on the hamster wheel just stutters every now and then. So forgive me if I slur my words or mumble my words because I just can't get them out right tonight. And yes, it was a late night. We were out pretty much all day yesterday. We got back at I think 1 o'clock this morning. So it was a late yesterday and a yeah, and still a long day today. So getting back, the US is strengthening its position as a global energy hub. We have increased domestic production, continued expansion in the Gulf Coast, and new refining capacity. Biggest news I've seen all week. The first major refinery is being built in Brownsville, Texas. It's the first new refinery in decades. And that matters because energy doesn't just impact gas, it impacts everything. You have more supply and better processing, and we get lower cost system wide. So if we take the 40,000 foot view, if we strip everything down, here's what matters. US GDP is still growing. Tax cuts are deflationary. More oil is deflationary. AI is deflationary. Catch the drift? Energy expansion is deflationary. Government spending pressure is being reduced. Less government spending is also deflationary. And the Fed should be lowering rates, but they're not. But even with the Fed hesitation, whatever excuse you want to give them, the direction is clear. We are moving toward a lower rate environment. And this is the part that matters most. When rates go down, bond prices go up. And income strategies tied to bonds, meaning some bond proxies also go up or those bonds strengthen. That's the primary current, and that hasn't changed. The herd doesn't chase currents, they chase reflections like headlines and oil spikes and conflicts and technology and momentum. They chase what just moved. We don't. We position what's already forming. We're looking ahead. 6 months ago, we talked about jailbreaking the economy. We're getting closer to that. You could argue it's already starting to break, and not in a bad way, like jailbreaking and freeing up the economy to just roar. And we're getting really close to that. But we're getting closer not because of my opinion or anybody else's opinion, but because the underlying pieces are aligning. So with that in mind, let's move into this week's closed-end fund snapshot and look at the funds that align with the most active currents. And the four currents are still active, but we do definitely have a primary current. So the primary current is bonds and bonds proxies. It's our focus unless we find an amazing deal in one of the other lesser currents. Secondary would be end-to-end energy, tertiary, real estate, and quaternary, you get AI, tech, and software beyond the big guys. So let's check out the snapshot for the week, and then we go from there. So let me share my screen. And this is last week's snapshot, and everything in this wonderful, brilliant green color is what I ended up buying. And I can get into that on another video. My goal is to update the portfolio this week and get a much better accurate representation of what's in the portfolio. This, or I guess how the portfolio is performing. This is the snapshot for this week. But I'm going to take off one fund. So, and I also have, see, I like AI, but I don't like AI for everything. I think it's a great source of information, but I think the people who are using AI, like you can feed AI a topic and it'll write a book for you. That is not me. That's actually what's called plagiarism. You're taking somebody else's work and labeling it your own. And maybe because you think it's not a person, it's fine, but it's not. Um, so at any rate, this is the list, but I'm going to delete RFI. Now, RFI sits in one of those other categories. It is on discount, and it's not generally on discount. It's still paying a solid dividend, the same dividend it's been paying. The yield overall has fluctuated because the price has fluctuated, but the dividend itself is consistent. And RFI sounds like a good deal. It meets the metric. Pricing is decent. Dividend consistent. Yield is still at 8%. It's not 9, but it's still decent. But it's not as good as what else is on the list. It's good. But if we're really prioritizing money and where money goes, we're prioritizing our income, consistent income is great. But in a market that's shifting to a lower rate market, a bond portfolio is just going to perform better. That's not me. That's just the data. And you could argue that real estate would perform just as well. And I mean, real estate would benefit from a deflationary market, but bonds are the primary current. So we end up with this 5 pack of bonds. Now, if the portfolio were updated and my spreadsheet were completely updated, it would show that we own these 4 bond funds. And I think we own them currently in both accounts. Maybe not DLY, but I want to say both the cash brokerage and the Roth own the top 3, and the cash brokerage owns DLY. I think, maybe not. We have PHK too. So, but NHS is new. And on my end of things, I don't like adding funds unless there's a good reason to add the fund. Like PIMCO and the double line funds, those have been on my watch list a while. And overall, I don't know a ton about NHS. I do know that the price fluctuates like everything else. I know the dividend has been crazy consistent, and I know the discount typically goes away. Like it's really not in discount territory. I mean, historically, it's low. 5 years is super low. So this is an anomaly. Um, so I asked AI to compare funds, and I wanted to share what it said. Because I mean, if I told you I said it, that would be plagiarism. Maybe you'd know, maybe you wouldn't know. But on my end, I would know that I can't do that. So I asked it to compare. I asked AI or Gemini to compare NHS with PDO, PTY, and DLY. And DLY, like the double line funds and the PIMCO funds, are nuanced. NHS is just it's a straight corporate bond fund with very little nuance. So then I said, okay, we'll compare it to DSL and BRW, two other bond funds that we currently own. Now, BRW is much more like a hedge fund or like an income vehicle, not quite like a bond fund. And DSL, yes, another double line fund, but also a nuanced fund. So it's just it's gosh, NHS is a high payout with a decent discount, and that discount has been known to vanish. So it's just I just find that interesting. Now, of the funds, PHK is supposedly the legacy fund that underperforms these two, which at 12%, it's weird to consider it an underperforming legacy fund. PTY is generally the gold standard, but it typically runs at a higher premium. And PDO lately has been uh, the favorite pony at the show, but it's a term fund. So I like them all. Would I consider buying NHS? I would. But to be quite honest, we bought last Monday. We're not going to buy tomorrow. I'm going to try to be. I'm going to try to be. I don't know the word right now. Diligent. Um, I'm going to try to stretch this out to buy. Like we just bought this month. I'm going to try to buy again a month from now, unless something changes. Like if the Iran treaty process goes down the tube and prices drop again at a fair moment, honestly, that's just a really good opportunity to buy. So we'll see how it goes. But these are the top five for the week. I for sure own four of these. NHS, I do not, but I mean, if I'm buying and I'm not, I would add it, but I'm not buying this week. So take it for what you will. Um, yeah, I mean, I've described all of these. Here, I'll display the boxes. How about that? Here, PHK, you can pause the video. PTY, stretch out the box. PDO, man, PDO, and then DLY. So I've gone into depth of why I like these funds, but they continue to stay on the list. And NHS is new, and with the market creeping towards lower rates. I mean, and I say creeping because we're all just waiting on the Fed. But with the market creeping towards lower rates, bonds are the place to be. So take it for what you will. That is the list for the week. And if I don't end it soon, I'm just going to ramble. And tired rambling is I think less favorable than regular rambling. So, in conclusion, you can't control the noise, but you can choose whether to listen to it. The waves are loud. They're always going to be loud. The waves are loud. The distractions are everywhere. But we're not here to chase reflections. We're here to find the current, and we're here to stay in it. Because when you're in the right current, the market does the work for you. The income continues, and that dividend dump truck keeps getting filled. That's all I have for the week. It's a super short video, which is great because I am exhausted and I feel it. But the the color guard season is coming to a close. Uh, it's one less trip to do, but we love those trips. So it's one less trip to do, one less responsibility, but something else is going to take its place. So that's all I have for the week. I'll see you next week. And whatever you have going for yourself this week, I wish you well. I wish you success. And I hope on your end that you're able to cross off some stuff on your list to free up some time to spend more time with your family. So have a great week, everybody. I will see y'all next week. Bye bye.